In this video, we'll go over a low-risk options trading strategy that will generate inflation-beating income with gains on upwards of 95% of trades. Our founder has used this strategy for 25 years, and once he realized how consistent it is, he abandoned all other trading strategies and focused on just this one. You'll be able to hear more from him in later videos to get specific examples of some of his top trades and weekly advice on how to use this trading strategy effectively. So make sure you subscribe. We should caution you, though, that having 95% plus trades be profitable does not guarantee an overall profit. If you make unwise trades, you can lose more in a single trade than you will make in many other small trades. We will help you choose the wise trades. Now, what this isn't. This is not a get-rich-quick scheme. Like all investments, the greater the risk, the greater the reward. What this strategy does is generate a steady stream of income with very low risk and quick, medium-sized returns. The goal is an overall annual return of between 8 and 12%, or a minimum of 5% above inflation. The strategy is about creating consistency for people who don't react well to losses and beating inflation in both bull and bear markets. This is also not the be-all end-all trading strategy. For example, standard market index ETFs from low-expense fund companies like Vanguard or Fidelity are still something that every young investor should have, whether it's in a 401k, Roth IRA, or other individual account. That is a long-term strategy that is intended to generate high returns over a long period of time. Like our option strategy, it is simple but effective and allows you to avoid the dangers of short-term emotional investing. What this option strategy is intended to do is to supplement those long-term strategies and give investors of all ages a way to invest that is far more consistent than market timing or trying to outwit the stock market. Instead, we exploit the understandable tendency of all advanced stock traders to do one thing: hedge their bets. We also enjoy researching options and tracking our trades. It's become one of our favorite hobbies, and maybe it'll be one of yours too. Now for our strategy: selling put options. You will need a general understanding of stock options and how options trading works, which many of you already have. So a put option gives the option holder the right to sell a stock at a predetermined price. Put options are really nice to have if the stock that you're holding suddenly drops in price. The person you bought the put option from is forced to buy it at the predetermined higher price. Our strategy focuses on selling put options. As the seller, you are essentially selling a promise to the buyer that you will purchase their stocks if a certain condition is met. That is, if the underlying stock falls below the strike price. Think of buying put options as buying insurance. You hope that you never need to use your insurance, but if there's a disaster, you will be very glad you have it. Other investors may purchase put options purely as a speculative bet on the decline of a particular stock or the market as a whole. And that's great. We need buyers to make our strategy of selling put options work by providing liquidity to the options market and minimizing bid-ask spreads. In our strategy, we act as the insurance broker. We sell put options to investors who want to hedge their bets. Picture it like this. You're a car insurance provider. People pay you monthly premiums in case they crash their car. Most months, hopefully, they don't crash and you keep their money. But every once in a while, someone crashes and you have to pay up. The goal is to collect enough small premiums to more than cover the occasional big payout. Like with any stock trading, you can be more or less risky with how you sell put options. Our approach is to accept low-risk, medium-reward trades. We have been burned in the past with risky bets and have learned to be cautious. Cowardice, for lack of a better word, is good. However, no matter how risky, the principle is the same. As the seller, you are betting on a stock not falling below a certain price, called the strike price, which would allow the option holder to force you to buy their stock at the higher strike price. You can sell puts for different strike prices. Like anything with stocks, the lower the risk, in this case the further the strike price is from the current price, and thus the less likely it is for the current price to drop that low, then the lower the return. We're okay with that. Let's take an example. If the stock is currently selling for $10, you can sell a put option with a strike price of $9, $8, $7, and so on, at any price that the options exchange lists as available for the underlying stock. It's more likely that a $10 stock will fall to $9 than it is to $8, and so on. Since the risk is higher for a $9 strike price, you can sell that option at a higher price than an option for the $8 strike price, because investors think they are more likely to need to collect on that insurance. It's like how you might have to pay more for flood insurance if you live in an area prone to hurricanes. So let's say you sell the option for 50 cents at the $9 strike price. If the price does fall below $9, let's say $8.75, the investor will exercise their option and you will be forced to pay $9, but will have made 50 cents. Losing 25 cents on the stock but gaining 50 cents on the option sale is excellent, as you'll have a net positive return. Now suppose instead the underlying stock drops to $7. You'll be forced to buy the stock at $9, and now you can only sell it for a current price of $7, with the put sale earning only 50 cents. That's an immediate loss of $1.50 per share. Now let's say in this case, it is really unlikely for the price to drop to $7. So instead of 50 cents for a $9 strike price, you sell the option for 2 cents at a $7 strike price. If the stock price does fall below $7, you have to buy the stock at $7, and in this case, you will only recoup 2 cents. Just like before, you can either immediately sell or hold the stock, depending on how you think the market will behave. If it dropped to $6.99, then you might go ahead and sell it, knowing you will be losing 1 cent on the sale, but having made 2 cents on the put. If it's lower than that, let's say $6.97, you might choose to hold the stock rather than take a loss and hope that the price goes back up. However, the key is that this is a very unlikely scenario to happen. It's low risk. What's more likely is that the option position will close without being exercised, and you will gain a profit of 2 cents. This seems like a very small amount, but consider that when you sell options, you normally sell in groups of 100, so that 2 cents is really $2. If you do this for a lot of low-risk trades, that $2 can quickly turn into $2,000 and so on. The annualized return for this trade, if your put options are never exercised by the put owner, would be roughly 14%. The average successful trade is well over 10% annualized, which makes up for the occasional losers, resulting in annualized returns of a minimum of 5% above inflation. Your goal in this strategy is to generate enough return from options that are never exercised that in the rare case that you do lose out on a trade, you'll more than be able to cover the losses and still come out with a net profit. What's even better about this strategy is that occasionally you will find a rare no-lose scenario. In a future video, we're going to go over a real-world example of a no-lose scenario that even the brokers didn't catch in time. Another consideration for options is the duration of time that the option lasts. Options are sold with time periods of a day, twice a week, once a week, or a month. The longer an option lasts, the more likely it is that something could happen that causes the stock price to go down. Thus, weeklies are less risky and less costly for buyers than monthlies, and so on. We trade almost exclusively weekly options because we like to avoid the weekend risk that comes with the monthly expirations, and because the rare daily put options are more difficult to sell since the insurance would only last for that day, the day of expiration, which makes daily options a lot less pricey and therefore less attractive. Weeklies are a happy medium, which suits our low-risk, medium-return strategy well. So why now? This strategy is relatively new and unique. It's only been in the last decade that this option strategy has become viable for making a profit. There are a few major factors that go into that, the first being that commissions are at an all-time low. Right now, options commissions are the cheapest they have ever been. Commissions will vary depending on what service you're using to trade. Many investors will start an account with an online brokerage like Charles Schwab, Fidelity, Robinhood. Anyone can also negotiate down their rates with their broker, and rates decrease as you make higher numbers of options trades. This allows for annualized returns of over 5% above inflation with relatively little risk. That was simply not possible before. Put options selling for a penny are now worth selling. The popularity of online trading is another factor. It's more popular than ever not only due to the lower costs, but also the greater convenience of trading online. Decades of online stock and option trading has led brokerages to create websites and apps that are easier to use and more useful than ever before. The greater popularity of options trading leads to higher volume, which in turn leads to smaller bid-ask spreads and more favorable prices. Price improvement, which is when the price you get is better than what you set as your limit, is also much more likely. A more recent change that's a little bit esoteric but still helpful to know is the reduction of trade settlement time from 2 days to 1. The main takeaway there is the same. Investors have better tools and financial incentives than ever before. However, that brings both promise and risk, where the risk is the greater likelihood of you rushing into an unwise trade. If you're nervous about getting started in the options market, some online accounts do offer a simulated trading zone. Those are where you can make pretend trades using real-time market prices. We would recommend simulated trading for between 6 months to a year if you have never traded before. If you are already comfortable making trades, just know that to trade options, most brokers do require that you go through an approval process. This approval process is pretty quick. It normally takes a day or two. And if you have trouble with it, you can always call the customer service for your brokerage. Once you're ready to sell your first put, you'll also need to have enough assets in your account that you can cover the cost if your put is exercised, and thus you are forced to buy the stocks the options represent. Remember, every option trade covers 100 shares of underlying stock, so you have to have the assets to cover the purchase of 100 shares per put that you sell. This is the real barrier to entry for the strategy, and it means a lot of people will need to start out selling low-risk puts on cheaper stocks until they can build up their assets. Okay, so let's quickly recap what we've covered. Selling put options is a way to make consistent, low-risk returns by taking advantage of the tendency of stockholders to hedge their bets. Selling put options puts you in the position of an insurance broker. We accept low-risk trades that will generate a small but consistent profit that really adds up and can more than cover the occasional big payout. You can sell options with varying durations, but for our strategy, we have found that weeklies work best. This strategy is new and untapped because only recently has it become a profitable form of trading thanks to lower commissions, increased online volume, and shorter trade settlement times. In future videos, we're going to go over real-world examples, weekly recommendations for put options to sell, and how to spot the rare no-lose scenario.